Bad news for the Biden administration, because there's no good news on the economic front for the Biden administration. The Fed has signaled that it is about to wildly increase the interest rates over the course of the year. According to the Wall Street Journal, the Federal Reserve signaled it would begin steadily raising interest rates in mid-March, its latest step toward removing stimulus to bring down inflation. Fed Chairman Jerome Powell said on Wednesday the central bank was ready to raise rates at its March 15th to 16th meeting and could continue to lift them faster than it did during the past decade. He said at a news conference, quote, "This is going to be a year in which we move steadily away from the very highly accommodative monetary policy we put in place to deal with the economic effect of the pandemic." Here was Jerome Powell announcing all of this yesterday.
Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus.
Well, that means that they're about to radically ramp up the tapering and they're about to radically ramp down the inflation. Well, what that means for Joe Biden is probably a slight spike in unemployment. It also means less investment just because there's less cash floating around. So you're going to see some stock market dips. That's exactly what happened immediately. Stocks sold off while Jerome Powell was speaking, reversing big gains from earlier in the day. By the way, there's certain areas of American life, I'd say many areas of American life, where we are just too reliant on quote unquote experts, administrative experts to run things. And when it comes to our daily lives, we are now reliant on 9 justices in Supreme Court robes, right? People in black robes telling us what to do. So we have to determine whether we get to keep employing our employees based on whether Justice Stephen Breyer has a bowel movement that day, right? That is not good stuff. We should not be relying on the Supreme Court of the United States to determine our liberties and our freedoms. And the founders actually never conceived of that sort of thing, that the Supreme Court was going to be the ultimate guardian of all freedoms and that everybody else would abdicate their responsibility on this level. So you'd have unelected justices determining our freedoms. And then the administrative state does the same thing, right? We have entire administrative bureaucracies that are specifically designed to control all aspects of your life. Thousands of pages of regulations every single year, tens of thousands of pages written by faceless, nameless bureaucrats with essentially lifetime appointments who it's nearly impossible to fire. And then you have the Federal Reserve, and we all react in the stock market based on what Jerome Powell decides to do today, whether his finger is in the wind that day. This is not how economies should work. And this is why the idea of a gold standard was a good thing, because it took out of the control of the federal government the monetary supply. We should not have the government determining whether we have inflation or not. We should not have the government determining whether the taxpayer is going to be buying assets from the market at large. Okay, this sort of thing is absurd on its face. The fact that this is how the stock market reacts, that you sit around waiting for Jerome Powell to make an announcement and then you trade stocks based on it, it's really unpleasant. When I say unpleasant, I mean that it is corrupt, it is corrupting, it is ugly, it is not relying on the diffuse knowledge of the market, it is relying on centralized bureaucrats to figure out what is best for you. It is the death panels of American politics, and these exist all over the place. It is faceless and nameless bureaucrats you've never heard of who are determining every aspect of your life, from the financial to your rights to how you get to flush your toilet. And it's really bad. And Jerome Powell is one of those people. The Federal Reserve was never meant to have this sort of power. The Federal Reserve was meant to be a backstop in case of runs on banks. It was not meant to be able to control unemployment and inflationary policy as a general rule. This has become what the Federal Reserve does, right? It's supposed to control unemployment. Anytime, like that in and of itself is crazy. Whenever you have a centralized bureaucracy that is attempting to control unemployment, why? That is not how the economy is supposed to work. And what it really is a mask for failures of the underlying economy. This is a case that David Bahnsen has been making, the investment guru. Right? What he's been saying is, we're all worried about inflation out here, and we should be, because inflation is a bad thing. But inflation is not the chief threat to the American economy. The chief threat to the American economy is lack of real growth, lack of real innovation, regulatory disincentives, tax disincentives, the Federal Reserve deciding whether or not people invest in your business based on how much money they blow into the economy or take out of the economy. Right? These headwinds are faced by actual business people every single day. And when the government gets control of every aspect of the economy this way, then what you are left with is a bunch of people attempting to read tea leaves and then trade your stocks based on them. The stocks sold off while Jerome Powell was speaking, reversing big gains from earlier in the day. The S&P 500 closed down 0.1%. The Dow Jones Industrial Average finished down 0.4%. The NASDAQ inched up slightly. Yields on 10-year Treasury securities climbed as investors anticipated a more aggressive path of rate rises. Powell left open the door to raising interest rates at consecutive policy meetings, which are held roughly every 6 weeks. The Fed hasn't done that since 2006. He said, I don't think it's possible to say exactly how this is going to go. I think there's quite a bit of room to raise interest rates without threatening the labor market. Powell's remarks led investors in interest rate futures markets to fully anticipate a March rate increase of at least 1/4 percentage point and a nearly 70% chance of a second rate increase by the Fed's meeting after that in early May. Powell suggested the Fed wasn't likely to offer any forward guidance, the term used for the central bank's statements describing its intentions with interest rates over the next few years. Forward guidance has been a central feature of Fed policy, so now they're not even going to give you any sort of guidepost for the next several years. So if you're an investor, one of the things that you search for is a solid investment that is going to give you return for the next several years. And in order to know that, you have to know what the Fed is going to do. Now the Fed is like, well, we could change on a dime, right? We could be fast moving. We need, boom, fast acting to acting of the financial markets. Well, that is not a good thing. There's an author named George Gilder who writes on economics all the time. When he has described the idea of what he calls information theory, the basic idea is this. When you are investing, you should think of investing as adding new information to a phone line. If there's a lot of static on the phone line, the new information may not get through. So the goal of the financial regulators should be to have a static-free phone line. In other words, the conditions don't change on the ground very fast. You have a lot of notice if the conditions are going to change, and that way you don't have a lot of sort of garbled interference from the top levels. And yet now the Federal Reserve is overtly announcing there's going to be a lot of garbled nonsense from the top levels. You're going to get staticky interference on that line on a regular basis now. In 2015, according to the Wall Street Journal, the Fed prepared markets for a mild path of no more than one rate rise every quarter by saying increases would be only gradual. Pressed twice Wednesday on whether the Fed would follow that approach, Powell pointed to how the economy is much different now with high inflation and very tight labor markets. The takeaway, said Christina Hooper, chief global market strategist at Invesco, is that this is not the last tightening cycle. We need to be prepared for it to be faster and for more substantial moves to be made over the course of the year. Relying less on forward guidance means that you risk unhinging market expectations about interest rates, said Vincent Reinhart, former Fed economist, who is now the chief economist at Mellon. Okay, so what this means is that you can't rely on what the Fed is going to do next, which means uncertainty, which means people take money out of the market. When people are scared, they take money out of the market, they start investing in things like bonds, right? They don't invest as much in stocks, they don't invest as much in mortgages, they just don't invest in as many things. So you're about to see a tightening because of the Fed getting involved this way, and that was brought about by the insane spending binge embarked upon by both parties, but especially the Democratic Party over the course of the last year and then over the course of the last 2 years. Right? During the pandemic, there was this idea that we could pay people to stay home. That might have been a decent idea in the first couple of months. Beyond that, once we knew the data, it made no sense whatsoever. We kept doing it. We blew trillions and trillions of dollars into the economy. There are people who ended last year with more assets than they had at the beginning of the pandemic, and they hadn't been back to work because we blew so much money into the economy. And now the Fed is forced to tighten interest rates and do so unpredictably. Meanwhile, the Fed released a separate one-page statement that spelled out high-level principles to guide a process for significantly reducing its holdings. The central bank in 2020 cut short-term interest rates to near zero and started buying bonds to lower long-term rates as the coronavirus pandemic hit the U.S. economy, triggering financial market volatility and a deep short recession. Officials pledged to hold interest rates near zero until inflation was forecast to moderately exceed 2%. Powell indicated that he and his colleagues believe those goals have now been met, and so now they have to divest themselves of the, I believe it's something like $9 trillion in assets that are being held by the Fed. It's something insane. Okay, all of this is bad news for the immediate future of the economy, but it's pain that has to be gone through because once you go on a spending binge, you wake up the next morning with a hangover, and that's really where we are at this point.